Happy Monday, everybody. I hope you had a good weekend. Last week's market update was on Wednesday, so I already recapped Monday and Tuesday, so I'm going to be brief on that today and then the rest of last week, and then let's preview this week and even the week after. Today is May 6, 2024, and this is your Monday market update. Coming out of the weekend, markets on Monday had the wind at their backs and a week of catalysts ahead. Monday did not have those catalysts, no Fed speakers, no eco data, no major earnings before the bell, so it just had momentum, but that just kept things churning around. Slight dip in the afternoon when the Treasury Department announced the refunding numbers, and they were about 20% higher than expected. A few months ago, that would have driven the market crazy, but not Monday. But yields did spike briefly, stocks dipped briefly, and the ship finally got its balance back pretty quickly. Markets did close near the highs for the day, getting set for the week and the news to come. All three indices closed up about 1/3 of 1%. If you're bored on Monday, Tuesday may have kept you out of your seat, not necessarily in a good way. Sea of red. Eco data led the charge, and a lot of stagflation talk. Employment costs up, home prices up, consumer confidence down. Remember, hot or sticky inflation and slowing growth is the recipe for stagflation. Markets gapped lower at the open, steadied, then took a leg lower when none other than Janet Yellen, of the Treasury this time, said that she was concerned about the direction of the U.S. deficit. Short yields went to session highs, stocks drifted lower. There was a lot of positioning into the pending Fed announcement in the press conference. I'll talk about that in just a minute. But by the end of the day, the Dow was down about 1.5%. S&P was down just a bit more than that, and the NASDAQ was down just over 2%. On Wednesday, stocks started out lower as stagflation conversations came from the latest eco data, also jolts from the job market. But after a bit of movement in the morning, the markets went into wait mode for the Fed and, of course, the press conference. FOMC was the catalyst, and Jay Powell was the spark. Statement was released, and markets read it dovish, and that put stocks higher and yields lower. Then Powell stepped to the mic, and as he tends to do lately, he made some news. Recall that for some odd reason, the markets have started to question if the Fed was actually going to hike rates again. So the sound bites were many. The one that most felt was the most important in regard to this, certainly, was that Powell made pretty clear, and I'm not sure how it could have been misinterpreted, that chances are really not there that the next move will be a hike. Pretty much took that off the table. Recall that the other fear was stagflation. I'm not sure if he thought he was in the position to joke or not, but my favorite line from the press conference was that, in his words, I don't see the stag or the flation. That was a great soundbite, but soon after the press conference, that exact issue, stagflation, reignited concern. Stocks rolled over. Higher for longer was the takeaway, and markets were not so keen on that for the moment, at least. One notable news from the Fed meeting without a rate change was that the other main tool that they have been using, quantitative tightening, QT, they did reduce the QT. In reducing the amount of treasuries coming out of the market from $60 billion a month to $35 billion a month, the results from that action are more demand for treasuries. And as I've been talking about for some time now, the amount of new U.S. treasuries that will come to the market due to the deficits we're running, we need all the demand that we can get. Overall, for the day, not much to see. The Dow finished positive by 0.25%. S&P and NASDAQ down each 1/3 of 1%. Thursday brought a relief rally, and markets took a second look at that Fed news, this time with their rose-colored glasses on. Tech earnings from Qualcomm were good. Jobless claims were lower than expected. Swiss CPI was hotter than expected. And as I tell you, it's odd where you hunt for news when there's nothing out there. As traders wanted to hear rate cut in the words, but there was little to drive that. But markets put the assumption of a September cut at over 70% probability. You know that I'm not in that camp. Markets ended higher. The Dow was up over 0.75%, the S&P up almost 1%, and the NASDAQ was up 1.5%. Then came Friday, jobs day, and what a day. Before you even got to jobs, Apple's earnings were very favorably received. I'm not sure how they could have disappointed because the bar was set so low. Everybody was ready for them to disappoint, and they did not bring that. So that already had markets looking up. Then the jobs number was way below estimates. Cooling economy, unemployment rate went up, wage growth was less than expected, pretty much Goldilocks, as described by most for the bulls. Eco data at 10 a.m. gave the market a slight pause about stagflation again, but that was short-lived. Markets got back into the buying mode, and by the end of the day, we were back in the green. Markets read the news in this way. Don't worry so much about an overheating economy, and we may still see rate cuts. I'd reiterate that I don't see that. I still see rate cuts far off, and I do see growth slowing. And at these levels, I'm concerned about that slowdown. I don't think markets are priced for that. Regardless, for the day, the Dow was up almost 1.25%, S&P was up 1.25%, and the NASDAQ was up just about 2% for the week. 2%. For the week, the Dow was up 1.14%, the S&P was up 0.5%, and the NASDAQ was up almost 1.5%. Let's see what we'll see this coming week. As I alluded to in the beginning of the video, the big news, CPI and PPI, is next week. So this week, there'll be a full slate of catalysts, but second level compared to that eco data next week. First, yes, Fed heads are back. We'll get Barkin, Williams, Kashkari, Jefferson, Collins, Cook, Bowman, Logan, Goolsbee, and Barr. Later today, we'll get one of those obscure but I think important reports, the Senior Loan Officer Opinion Survey. This will give us some more view from the street level on the economy. Other eco data is slim, jobless on Thursday as usual, and the University of Michigan survey on Friday, consumer sentiment and inflation expectations. The earnings will also be on the agenda, some big ones like Disney and BP, some of the disruptors, if you can still call them that, Airbnb and Uber. We'll see important news across the pond as the Bank of England will have a policy meeting, and though they are also not expected to cut rates at this meeting, will they telegraph an upcoming cut? And will that break the dam? ECB and Bank of England are both expected to cut in June, and that expands the gap between the Fed and those two. So think dollar. The stronger dollar, think headwinds on global stock earnings. If the BOE does not forecast a cut in June, that'll probably be seen as positive. So that is this. So that we'll have to watch on that. That's this week past and the week yet to come. There are a lot of cross currents going on, but note that so far earnings are coming in pretty good, and I remain convinced that that is the key, earnings. So watch that, and then CPI and PPI are next week to get a new read on the inflation. Until then, please check back on Friday for another planning video, and also check the website for updated blog and research. Call me with any questions. Have a great week.